Hello, everyone. I'm Brad Long, Partner and Deputy Chief Investment Officer at Fiducian Advisors. In light of the recent market volatility, we put together what we call the Bear Market Field Guide. It's our enduring wisdom of how to navigate periods of volatility like we've seen recently. And there are 5 key points we want you to take away. The first is around context. We very much appreciate that bear markets and recessions can be uncomfortable and even create anxiety. But there's a difference between uncomfortable and uncommon. As you can see on the screen here, garden variety volatility of say 5% drawdowns, those happen about every month and a half and are just a regular part of investing in markets. But as our gaze turns to the right here, looking at drawdowns of 20% or more, or recessions, as we've experienced recently, while not happening every month or month and a half, they do occur about every 6 or 6.5 years, respectively. And so when we think about the long-term benefits and wealth creation that markets have created over time, they have happened with bear markets and with recessions, not by avoiding them. Which brings us to our second point. Periods of volatility, and especially periods of being uncomfortable, creates an emotional need to react. We feel like we want to react. After all, we are humans. We are built fight or flight, right? That is a reaction, an emotion. As you can see in the graphic here displayed, this is consumer sentiment. The higher the line, the greater the optimism. The lower the line, the greater the pessimism. Now, by investing in periods of high optimism versus investing in periods of peak pessimism, you have very different outcomes. In fact, investing when things feel the worst, on average, has been 6 times more successful than the opposite. So in this instance, our feelings are betraying us. The feeling of wanting to act or the need to act is not giving us a good, clear signal on how we should be acting for the best outcomes in our portfolio. Which brings us to the next point, and the most tempting one, timing the market. Our third point is market timing is hard, and the cost of getting it wrong is high. So, first off, we do not recommend market timing because we don't think many people can successfully time markets. It's a difficult thing to do. But we want to display even the cost of getting it wrong. Here, we're showing the cumulative return of investing just $10,000 since 1980 in the S&P 500 through the end of 2021. And that $10,000 not touched would have grown to almost $1.7 million. That's an incredible return over time. Now, by missing just the best 5 days, that's only 5 days of almost 10,000 trading days, you would reduce the portfolio's total return by 43%. And by the way, those 5 best days happened in periods of high volatility and oftentimes in periods of recession. So getting back to this emotional need or want to take action in periods of volatility, oftentimes those emotions are betraying us and trying to tell us what to do and kind of the wrong time to do it. So that brings us to our fourth point. Well, if we're not trying to time the market, what are we doing? Well, our fourth point is we are investing over the long term. As you can see here, long-term investing is far more aligned with bull markets than it is bear. Not only are they more frequent bull markets, they last longer, 71 months versus 14 months, but they're far more impactful too, with a cumulative return of 263% versus a drawdown in bear markets of 33%. So by keeping our gaze over the long term, we're far more likely to gain the benefits of the more frequent, longer, and more impactful impacts of a bull market than we are in the less frequent, shorter, and less impactful impacts of a bear market. This brings us to our final point, which is relevant to today and a lot of the discussion we're having around a recession obsession. Markets and commentators are often focused around, are we in a recession or not? And recessions, their start dates and end dates, are very much backward looking and aren't all that helpful of a guide when we think of investing and trying to allocate capital. In fact, as you can see on the graphic here, on average since 1950, markets have peaked 7 months prior to an economic peak, and they've bottomed 3 months before the economy began to grow again. So even if we were able to perfectly time the start and the end of a recession, we would be focused on the wrong thing, and we largely would have been too early and too late. So with those 5 points, we believe that investors can help navigate these periods of volatility. And they do bring us back to our core tenets in portfolios and allocations. 1, stay diversified. Diversification and limiting singular bets help investors navigate periods of volatility. 2, stick to a plan. If you didn't have a plan coming into this, give us a call. If you did, that plan was built with the idea in mind that bear markets are going to happen, and we understand what their impact is over the long term. That plan will help guide us through these periods of volatility. And finally, stay long-term. Long-term investing is where the real money is made. Short-term investing oftentimes leads to more losing propositions. We appreciate periods of volatility are not comfortable and can create anxiety. So as always, feel free to reach out with any questions. We're always here to help. Thanks so much.